Good day and welcome to Varun Beverages Limited Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on Varun Beverages Q1 FY22 Earnings Conference Call. We have with us Mr. Ravi Jaipuria, Chairman of the company, Mr. Varun Jaipuria, Executive Vice Chairman and Whole-Time Director, Mr. Raj Gandhi, Group CFO and Whole-Time Director, and Mr. Kapil Agarwal, Full-Time Director of the company. We will initiate the call with opening remarks from the management, following which we have the forum open for a question and answer session. Before we begin, I would like to state that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation shared with you earlier. I will now request Mr. Ravi Jaipuria to make his opening remarks.
Good afternoon, everyone, and thank you for joining us on our earnings conference call. I hope all of you had the opportunity to go through our results presentations that provides details of our operational and financial performance for the quarter. We have started the year on a strong note, delivering notable growth across all parameters. Robust demand in both domestic and international markets, also supported by the early onset of summer in India, translated to healthy volumes during the quarter, which grew by 18.7%. This, along with improved net realizations, resulted in a solid net revenue growth of 26.2% Q1 2022. On the profitability front as well, we have delivered enhanced performance despite significant increase in input costs witnessed during the quarter. Our EBITDA grew by 39.1% and our margins improved to 18.8% in Q1 2022. On the demand front, we are seeing a solid uptick in consumption. The summer season in the domestic market has begun well, and as we enter the peak months, we are well prepared to cater to the anticipated demand by optimizing our capacity utilization across all plants and further enhancing our reach across establishments and under-penetrated markets. During the quarter, the board approved the proposal to manufacture Kurkure Puffcorn for PepsiCo India as part of their network of co-packers. The commercial production is expected to begin from Q3 of 2022. As we look ahead, on the back of an improving demand environment, we remain confident of delivering healthy volume growth in the medium to long term. We are also happy to share that as a token of appreciation to all our shareholders, the board today has recommended a bonus issue of 1 equity share for every 2 shares held by shareholders of the company as on the record date. Overall, our initiatives today towards improving our market share, building infrastructure, and expanding reach continue to hold us in good stead, and we are confident of delivering strong and sustainable growth going forward. I would now invite Mr. Gandhi to provide the highlights of the operational and financial performance. Thank you very much.
Thank you, Mr. Chairman. Good afternoon and a warm welcome to everyone joining us today. Let me provide an overview of financial performance for the first quarter ended 31st March 2022. Revenue from operations adjusted for excise GST grew by 26.2% year-on-year in the Q1 2022 to the level of 28,274 million rupees. Total sales volume grew by 18.7% to the level of 179.7 million cases in Q1 2022 from the earlier level of 151.4 million cases in the quarter one of 2021. On account of strong demand environment across geographies, CSD constituted 70% juice mix of 7% and packaged drinking water mix of 23% of total sales volume in Q1 2022. Realization per case improved by 6.3% to 157.3 in Q1 2022, led by price hike in select SKUs, change in SKU mix, and higher realization in international markets. On the profitability front, EBITDA increased by 39.1% to the level of 5,310 million rupees in Q1 2022. Gross margins for Q1 2022 reduced by 427 basis points to the level of 51.5% from 55.8 in Q1 2021, primarily because of increase in preform prices by around 30% over Q1 2021. Despite the decline in gross margin, the company was able to improve its EBITDA margin to 18.8% during the quarter because of higher operating leverage driven by strong volume growth and high realization. Finance cost declined by 19% to the level of 469.6 million during Q1 2022, primarily because of lower average cost of borrowing. PAT increased by 98.2% to the level of 2,710 million in Q1 2022 from rupees 136 crore or 1,367 million in Q1 2021, driven by improvement in margins, reduction in finance cost, and higher profitability from international operations. Overall, during the quarter, we have reported an encouraging performance. We have seen a strong demand environment and are excited about our prospects going into the peak season, and our outlook remains positive for all our product categories over the medium to long term. On that note, I come to an end of the opening remarks and would like to now ask the moderator to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, good afternoon, everyone.
Good afternoon, Percy.
Hi, good afternoon. When you were doing the Pepsi acquisition, just before that, you had shared that your market shares in South and West would be around 25%, and in your core geographies, the existing geographies, they were about 40%. Now, of course, we do not expect you to update us on this on a regular quarterly basis, but since it's been 3 years since then, would you give us an idea on what kind of market shares stand today versus what you had shared earlier?
Percy, the only thing I can tell you is after our acquisition for last 2 years, we could do very little because both the years in the peak season, COVID was there. And so what we really needed to do was enhance our go-to-market, increase our distribution, which we had started in 19 but could not completely go through with that in 2021 because of the peak season disturbance, which this year is the first year where we are seeing that the change happening and when our distribution enhancement is starting to give us encouragement and giving us results. So that is why you are seeing better numbers, and even in the off-seasonality quarter, we are seeing better results because the territories which we had acquired have started doing well.
So the context in which I asked this was, if I look at this quarterly result and tried to calculate the organic volume growth on a 3-year basis, using 3 years because 2 years also is not a normal base because of COVID. So now we have to look at 3 years. So on that basis, the organic volume growth for the India business is 10.5%. I just wanted to understand whether the industry itself is growing at this rate, or is it market share gains which is leading to such robust growth? Because in this kind of a consumption environment, no other FMCG company is reporting a 10% kind of a volume growth. In fact, most of them will report close to zero volume growth this quarter. So just understanding the source of this growth, is it a broad-based industry growth itself? And if so, why is this industry so different from the rest of the FMCG pack? And if not, then obviously it's a market share gain.
Well, partly the industry is growing, so it is not only that we are growing. I think competition is growing also. Obviously, our enhanced go-to-market is giving us some results, so where we feel we might be doing better, but I can't really be sure of that because those numbers are not available. But I think overall, if you look at it, the season has started a little earlier also this year. The summer started a little earlier. So I think everything put together and overall our real enhancement in go-to-market, which is the key issue in this trade, and putting enough chilling equipment is what is helping us grow the market.
Any data you can share on the increase in distribution touch points or the increase in the chilling infrastructure that you have effected?
Sure, Percy, that data is that in the quarterly result presentation also is given here. What I would like to tell you is how we are increasing our penetration in the market, not only the distribution go-to-market, also we are trying to enrich our product portfolio over last year. If you see in the last 2 years, what has changed for us is same, which is energy drink. And last year, the growth in that particular segment was 440% and became 5% of our mix. And in this quarter also, that has grown 131%. Also, the dairy products which we have started, and we are already booked to our capacity to the full. Tropicana, which we took first, there are phases. When we first, they had never franchised Tropicana anywhere in the world that, they gave it. They chose Varun Beverages, they gave it to us. Second, it was always for last 10, 15 years was getting co-packaged from third parties. We put a facility, started in-house and made it profitable so that we can earn and flow back this for the growth of that. And happy to inform that we are already 100% capacity utilization on Tropicana, and we are feeling necessity to double our capacity by next year. And if we do that, the way the demand is coming, unfulfilled demand in that field, I mean, there is a huge growth potential. So another factor other than go-to-market is the product portfolio enrichment.
Understood. Also, can you give us some guidance on your capex, not the total amount, but things like in the international geographies, where do you think, if at all, you would require capacity enhancement, and whether it can be done through a brownfield or would you need a greenfield? And similarly in India, now that you have a very sort of robust footprint, presence in almost every state, do you think that most of the capacity enhancement in India can also be done through brownfield rather than greenfield, given that most of our facilities have sort of excess land on which brownfield expansion can be done?
See, we try and enhance our capacity wherever it is possible by brownfield, since we have plants in most of the states. But due to our water utilization, some of the locations, even though we can put up another line, the amount of water we draw does not allow us to put any more lines there. So we have to go for greenfield plants. So that is one of the conditions which changes some of the brownfields into greenfields. And the one state which we didn't have a plant, which was Bihar, we have just started our plant. on April 1st, and that is doing extremely well for us.
This year's result, Percy, you will see, in the presentation that Sandila, we increased the capacity, which was a brownfield. Bihar, where we didn't have a plant, and last time when we mentioned, it was driven for arbitrage between freight versus fixed expenses, but that proved to be a very good decision, and that capacity is becoming very handy to cater to the growth there. So it's going to be a mix of the two, at least for some more years. And on the international front, last year we had doubled the water capacity in Morocco, which due to Delta, they could not be implemented during the season time. It got implemented in August, the fruit of which will be available this year, and that's running to its capacity. And in Zimbabwe, we are adding our capacity this year. By May, June, it will be implemented just before the season there. And that capacity increase is going to be, because last year Zimbabwe got support from Zambia. This year Zambia will be feeding DRC, where we are not going to make any investment till we test the market. So these are the international capex plans.
Right. So in terms of monetary amounts, if you can give some rough number for CY22.
It won't be very large, Percy. This year it won't be very large because the water line was already put last year in Morocco, and DRC is going to be fed from our Zambia line. It's only one line which we are adding, so about $10 to $15 million is the total capex we are looking at internationally.
Sorry to interrupt, Mr. Percy. May I request you to please rejoin the queue? We have participants waiting for their turn. Thank you. The next question is from the line of Himanshu from Yes Securities. Please go ahead.
Yeah, good afternoon, team, and thanks for taking my question. So, sir, firstly, just to understand this quarter's performance, I mean, there was a commendable reduction in expenses below the gross margin line. So, just wanted to understand, I mean, this sort of operating leverage, is this completely operating leverage, or there were certain one-off benefits or cost reductions as well that we sort of saw? Just wanted to understand whether we can operate at broadly these level of employee and other expenses basically, and can we benefit significantly in that case once the gross margins start recovering again?
This is mostly an operating leverage, yes, because the volume has gone up and there was not a change in fixed expenses.
Yeah. So you mean to say if this sort of volume growth sort of continues for us, I mean, and once the gross margins recover, in that case, we should be looking at significant margin expansion, right?
See, the gross margins, presently, as we stated that what we have done is because the demand was quite strong and the commodity prices had gone up, the discounts were curtailed to the maximum. And once the price increase happens, discounts may come back. So I don't see a big jump in the profit margin except to the further operating leverage. As we have stated in our earlier call, about 23% of our annual volume we do in the first quarter. And second quarter is 1.5x around of the first quarter's volume equivalent. So operating leverage in next quarter definitely will be there, and operating margin in next quarter is definitely going to be much superior than the first quarter. But it is not true for all the fourth quarter. Third quarter may look like the first quarter. Fourth quarter will be depressed.
Right, sir. Right. And sir, in terms of gross margins, can you talk a bit about in the current quarter, how are we seeing our raw material prices, whether we might need some amount of price hikes?
Well, if you saw, we had borrowed extra money and we had stored enough. Our key ingredient is PET resin, which we had kept stored enough for the full season. So we don't see any challenge on that front, even if the prices go up, because we are already sitting on stocks with us. and concentrate is fixed, so there's nothing. Sugar prices are reasonably within the same range, maybe 1 or 2 rupees up or down. So we don't see any cost escalation further. And the competition has taken some price increase, and we have also taken some price increases, so that benefit will come in this quarter.
Understood. And sir, second question was on the write-off. I think we've taken a 14.5 crore write-off on some plant and machinery. But we don't see that flowing through the P&L. So is it a direct adjustment from the balance sheet that has happened in that case?
It is through the other expenses it's coming to the P&L, and this is actually there. Basically, we were left only with the glass line. Water line in our consolidation process was already shifted to Gujarat plant, and water line, the glass is unfortunately not growing. So it took the plant machinery, glass and very small can line write-off, because after the glass doesn't work, only a small can line running a plant doesn't make sense, because we have seen with our experience, larger plants, the cost of production per case reduces substantially, which now we are up to, and that consolidation process for the next few years may be going ahead. Therefore, there can't be straight answer like in the earlier question that will everything be brownfield? Maybe, may not be, because consolidation is going to be the key in next few years.
Got it. So adjusting for this 14 crores, our operating margins are even higher, because you're saying this 14.5 is a part of other expenses. That's correct, right, sir?
That's right.
All right. That's great, sir. Thank you, and all the best to you. Thanks for taking my question, sir.
Thanks.
The next question is from the line of Shrenik Bachawat from LIC Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity and congrats on great set of numbers. Sir, could you please explain if electricity issues are being faced in various parts of the country? So will that impact our business in any form going forward?
Well, we are not facing any major electricity issues anywhere, but if there is any, it doesn't affect our business, because we are fully backed up with generators. So as the overall production, there will be no constraint. It might be that if there is less electricity, the cost might go up slightly because of generators, but it's not very significant. So
no, sir, I mean to say from the distribution side, the retail outlets, and will they be affected?
No, we are not seeing any challenge as of now.
Sure, sir. And could you share the utilization levels currently? And previous year, if I'm not wrong, it was around 60-65% in the peak season.
Well, it used to be.
Last year we didn't have a peak season, unfortunately. So April, May both were COVID, so you can't take up But this year we are trying to utilize our lines as much as possible. Actually, we are running our lines fully. Actually.
Okay. And sir, this last question: could you share the volume growth expectations and EBITDA margin expectations for CY22?
Well, we have just said that, our first quarter is about 23% of the mix. So we expect hopefully the volume should be based on that. And EBITDA margins are always higher in the second quarter because of the volume growing up. So it's looking quite healthy.
On full year basis, CY22 full year basis margins, what can we expect?
We I think did 21% or so in 19, which are our normal margins with operating leverage little bit here and there. I think we calculate. For us, it will be a little difficult to give any guidance on that.
Sure, sir. Okay, thanks. The project.
Thank you. The next question is from the line of Dhruv Bhimrajka from Monarch AIF. Please go ahead.
Yeah, good afternoon, sir. Thank you for the opportunity. Sir, my question, I have just 2-3 small questions. One is, what would be our volume split between domestic and international market for the first quarter?
Out of 180, 147 is India, balance is international.
Okay, so 147 and 33, right? Okay. And sir, as of the quarter ending 4Q CY21, we had a net debt of approximately 3,005 crores. So in these 4 months, what is the debt that we have repaid, if any, and what would be our net debt as on date or as at end of the first quarter?
Yeah, it's a 3,100 and some odd figure as on 31st March. And that also included because of the inventory which we created for PET stocking.
Okay. So so there's no debt repayment as such in the first quarter, right?
This is yeah, because in the first quarter we have paid for the capex for Jammu plant, which is for backward integration. We also have paid for our Sindila plant, which is a brownfield expansion. We have also paid more or less fully for Bihar plant, which got implemented in this month. So that capex then without raising any additional debt is already taken care.
Okay. Okay. And sir, so you said last question is that for CY22, you said for international markets there would be a 10 to 15 million USD capex. So how much would it be for the India market then?
In fact, this up to May, that 10 to 15 million, which is from the internal accruals being paid already, side by side, no debt increase. For India, actually, I think what we would like to restrict ourselves is by saying that, which we are saying for last 5 years, equal to the depreciation figure to cater to the normal organic growth 10 to 12% level. If we grow, say, 1.5x, so 1.5 years equivalent depreciation, if we say grow 2 years equivalent, so 2 years equivalent depreciation figure. So, I mean, we have given a guidance to this formula. And, projecting future is little difficult. And here, actually, what I would like to tell you is, by June end, we will know broadly which direction we are going ahead. And at that point of time, we will be forming up our capex plan, and we'll be able to share. Till then, it's only a speculating. I think we'd like to stay a little away from there.
Okay. Okay. Thank you so much, sir. I'll get back in the queue.
Thank you. The next question is from the line of Jaykumar Doshi from Kotak. Please go ahead. Mr. Jaykumar Doshi, please go ahead with the question. Your line is unmuted.
Hi, thanks for the opportunity and congratulations for a great set of numbers. My first question is the 16-17% volume growth in India is very impressive in context of what we are seeing in FMCG as well as Alcobev company that has recently reported. So is this growth broad-based across geographies? Are you able to sort of, is the environment conducive for you to grow double digits in North and East markets as well?
Oh, this has been broad-based, so it's not only the South and West. The growth has been reasonably good throughout the country, give or a little bit depending on the rains and the weather, but mostly it's been broad-based.
That's great. Good to know. So in from South and West, when do you think have we hit a kind of an inflection point, or will we see accelerated growth in this season, or you think that it will be next season?
Well, I think we are already seeing accelerated growth from South and West and all the territories which we had acquired. So wherever there are very weak territories, we are seeing additional growth coming in.
So it has started to contribute. Great.
Yeah,
great.
It has started.
Right. On international markets, again, 30% volume growth is very good. Other than Sri Lanka, are you seeing any kind of operating challenges or currency related issues in any market, or do you see any risk in context of inflationary?
Even Sri Lanka, business-wise, we are still doing all right. We would be one of the companies which is still not going negative in Sri Lanka and continuing with minor growth. Obviously, the foreign exchange challenges are there, which we are managing, and there will be some challenges, but it's such a small part of our business that first quarter growth Sri Lanka. And actually, if you look at the first quarter growth, Sri Lanka has grown at 37%. So Sri Lanka is also growing for us.
I would assume it's local currency. It must be local currency, 37% growth, right?
Yes.
In fact, these are volumes. So
No, this is volume. No, this is volume. So this is not currency related.
Understood.
This is actual volume growth. So currency related is completely different.
Thank you. And my final question is, the partnership with Pepsi in foods business and, starting as a co-packer, are there other players globally in other markets where this model has evolved? And the idea of asking is, beverages it's a well-established model of bottling all across the world, and it's a very high gross margin business as compared to foods business. So are there similar partnerships that have evolved where we can look and to get a better understanding of how this journey can shape up?
Not to our knowledge. So we might be the first in the foray. So we are also learning from it. So that's why it will be an interesting start. And let's see where it takes us.
That's it from my side. Thank you so much, and we're looking forward to a great season.
Thank you, Jay.
Thank you. The next question is from the line of Nihal Jham from Edelweiss. Please go ahead.
Yes, sir. Thank you so much, and congratulations on the strong performance. So 3 questions from my side. The first one was, just delving into the strong volume growth. If you had to compare, say, from 3 years back, has there been any significant change in the product mix other than say Sting being added versus CY19?
Yeah, if you look at it, the 3 products which Mr. Gandhi said, Sting, of course, has been a very strong performer for us. Our value-added dairy has done extremely well, and Tropicana juice has done extremely well for us. So all the 3 categories have done extremely well for us. Apart from of course, our core business, which is CSD and other juice and water category.
Absolutely, that's helpful. Mr. Jaipuria, would it be possible just to give a approximate proportion of what these 3 specific products would make up at this point in time of our total volumes?
These new products, last year 23-24 million was Sting.
No, I think it's about, Sting is about 6 to 7% of our mix.
Yeah, in this quarter.
In this quarter.
Yes.
I'm giving you very approximate numbers, so.
That will help, yeah.
What is the mix? And, in value-added dairy and Tropicana, we've run out of capacity, so we are producing 100% to what our capacity is, and unfortunately it will not show a seasonality dip or going up because we'll continue producing 100% of our capacity. So those volumes will only go up now once we add capacity to to both these products. So Tropicana is 2%.
And dairy?
Dairy is about 0.5% for the time being. So that's basically the capacity of the unit which we had put up in Pathankot.
Is Tropicana and dairy both are fungible on the same equipment? That's another constraint. But
so that equipment is giving us about 2.5% mix for the time being, and about 7.5% is Sting. So between the 3, you're talking about 10%.
Which you can say would be close to negligible at least 2 to 3 years back.
Which was practically not there, yes. Practically very small.
That is very helpful. The second question was on this puffcorn arrangement. I know we've answered, but just at this point in time, while the current arrangement is a co-packing, is there a discussion on the table that you take up the distribution similar to the beverage business? And just to understand that, would say the food business require a manufacturing setup as intensive as what it is for beverages, or how would it be say different in case this fructifies in the future?
It's a bit too early. Let us start with the first unit. Let us understand this, and right now it's a co-packing arrangement only. So I think we'll stick to that for the time being and understand it before we can talk anything more.
Sure, Sir Jaipuria. My last question was on the debt side. We've obviously, given the strong run rate and performance, there will be significant cash generation that will accrue in our key second quarter and for the year. other than debt repayment, or is it fair to assume that most of this will be used for, say, debt repayment, or how should we look at it?
I think part of it will be definitely used for debt reduction, and some of it will be used for capex enhancement, because with the run rate, the growth which is happening, we would have to spend some more money on capex.
Understood. This is helpful. I wish you all the best. Thank you so much.
Thank you.
Thank you.
Thank you. The next question is from the line of Devanshu Bansal from MK Global Financial Services. Please go ahead.
Yes, hi. Thanks for the opportunity and congratulations on a really strong set of numbers. Sir, to build on the question asked earlier on international geos, as I view, the base quarter was also quite strong here, and on that base we have grown about 30% in volumes. Just wanted to understand the drivers of this strong growth, as well as any outlook here that you can give us for the coming years would be helpful.
No, I think one was, if you looked at Morocco, by the time we were able to put up our line, it had passed the season because of COVID. We couldn't get the people, so that performance is that enhancement of the additional line has started giving us results. And Zimbabwe is also, the addition what we did last year has started giving us results. So, and even if you look at Sri Lanka, which has done very well. So if you look at Morocco has grown at 50% for us. So that has given a big spike, and Zimbabwe has done well for us. Actually, all the countries have done well for us. So it's very difficult. So I think it's not just a spike. I think the overall business has improved, and I think we look at some good results going forward also.
Sir, going ahead, any outlook you can provide, as in if Morocco now CY22 would be a good base, and upon that, what is your outlook on growth in these geographies?
Well, Morocco has become a reasonable sized business for us, and because of the growth in volumes, it has become a profitable and good business for us, which we were struggling for quite some time before. So that's the guidance I can give you.
Sure, sir. Sir, I understand since lemon is a very large market, so how is the traction for our other new launch, Mountain Dew Ice, and are there any marketing plans that we intend to launch going ahead?
No, I think we've got our hands full this year with with the Sting and Mountain Dew Ice. We are already launched last year, so it's doing extremely well for us. And with value-added dairy as well as Tropicana, we have got enough, and even Gatorade is doing extremely well this year for us. So I think we have enough products, apart from our core business, which is growing at a very healthy volume, which you are already seeing.
Sir, I was specifically asking for Mountain Dew Ice, not a new product.
No, Mountain Dew Ice is doing well for us, but we are whatever limited capacities we have, we are producing it, and it is selling to the capacity actually.
Sure, sir. Lastly, sir, in terms of PET stocking that we did in December 21, what would be the crude price levels at which we stocked PET in December?
That's very difficult for me to, but we bought it at a reasonably decent price because we bought it mostly at the end of the year.
Sure, sir. That's helpful. Yeah, that's it from my end. Thanks for taking the time.
One is the price, suppose second was the de-risking against the logistics risk or issues. So at least this decision proved right for us, and we still have enough the whole season.
Sir, my question was from going beyond H1. So if crude prices increase from current levels, then maybe gross margins can see an impact.
We will cover till a little more than H1. So maybe even the third quarter is reasonably covered.
Sure, sir. That's helpful. Yeah.
Thank you. The next question is from the line of Suman Kumar from Motilal Oswal. Please go ahead.
Yeah, hi sir. So can you talk about the out of home consumption trend and how is the contribution in this quarter?
See, the biggest growth which is coming is out of home now. So out of home, people are all in the market. So that has increased significantly because till last year the home consumption was major quantity was going in home consumption. But now home consumption is about 30-35% and on the go is about 65%.
Okay. So the major volume growth happened in this quarter is, can we say 60-65% is volume growth from the out of home?
Out of home is more, absolutely, because there's no more restrictions, so everybody is going out, and because before it was mostly at home.
Okay. And 6% realization growth, can this trend is going to continue for the coming quarter also?
Looks like it should be.
Okay. And sir, what is the capex number for FY22?
It's a bit difficult to tell you exactly, but as Mr. Gandhi said, the guideline that if it is about 10% growth, our capex would be approximately to our depreciation level. And if this growth doubles, then our capex would be double of our depreciation level. Approximately in line with that.
Thank you so much.
Yeah, thank you.
Thank you. The next question is from the line of Rakesh Roy from Insec Securities and Finance Limited. Please go ahead.
Hi, sir. So my first question is regarding your international business, especially
I'm sorry to interrupt you, sir, but we cannot hear you clearly.
Hello.
Yes, please.
Yeah. No, sir, I just want to, can you highlight on international business, especially in line with the Sri Lanka issue and Nepal issue, sir?
There's no issue in Nepal.
Yeah, Nepal, sir, they are trying to restrict some import from other countries.
No, but they are not restricting manufacturers. So that is for luxury goods and that is for basically traders. It's not for manufacturers.
Okay.
So it's not impacting us at all.
Okay, sir. Right, sir. For Nepal, sir, it's for Sri Lanka. Sorry, sir. For Sri Lanka?
Sri Lanka, I mean, we all know there is a foreign exchange crisis which we are managing. So the business is doing extremely well still. We are managing with it, and I think it's such a small part of our total business, is 1.5% of our total volume. So I think we just need to wait and see what happens. I feel they'll come out of it. Will it take 3 months? Will it take 6 months? I don't know. But we are managing, and our parent company is also supporting us. So I'm sure we'll manage.
Right, sir. So my next question is regarding, sir, out of India total volume 147, how much is the southwest, this one, sir, southwest market?
About 1/3.
1/3, sir.
Yeah.
Okay, sir. Regarding, sir, your new, sir, you just want to try to understand, sir, your geography-wise mix, sir, regarding in India business, sir. Can you give me the idea how much the geography-wise mix?
What? I didn't get your question.
Okay, my geography-wise mix in the sense ki north and south and east and west.
But this will keep changing, this will keep changing. Every quarter is a different mix because seasonalities are different for every quarter. And we've really not had a full year of proper year, which we hope we'll get this year. So I think you should give us this year to really find the real mix of each geography.
Understand. Right.
It won't be right to give the mix for, summer is, April, May, June is always higher in north. October, November, December, or January, February, March would be better in south and west. So it's every quarter is a different story.
Right, sir. Yeah, thank you for much, sir.
Thank you.
Thank you. The next question is from the line of Sanjay Satpathy from Ampersand Capital. Please go ahead.
Hello.
Yes.
Hello.
Yes, sir, we can hear you.
Yeah, sorry. Sir, I just wanted to confirm this 15 crore WDV that you said, so we should reduce our other expense and see the normalized margin by adjusting that. That is what you said, right?
That's right.
Yeah. So that is the 19%.
Whatever that percentage is.
Yeah. And the second thing that you mentioned passingly that typically this quarter one is 23% of your sales volume. Am I right, sir?
Generally.
Approximately.
Okay. And lastly, just wanted to confirm with you that this 25% CAGR over a 2-year period that we are seeing, which most people are finding difficult to kind of understand that why it is happening and what is sustainable. That is because historically you have been saying that this beverage business will grow at about 10 to 15% volume growth annually. So are you kind of saying that this kind of a growth is a one-off and it will come back to that level pretty soon, or you are saying that because of the initiatives that you have been taking, you have been gaining some kind of market share, and that is why one can look for not 10% but rather 15% kind of a growth sustainable in near future?
Well, we always said the market should be growing at 10 to 15%, and we will always keep trying to do better than that. But will we succeed or not? I don't know. Our job is to keep trying.
Understood. And if at all you will be successful, that is primarily because of this foray into South, which will turn around, and also these factories that you are expanding, right, sir?
Well, we hope so. Yeah.
And last question, sir, I just wanted to check with you that I am seeing that between your different categories, the juice segment is kind of relatively subdued. And is there any explanation for that in terms of the outlook and how it will kind of also plug growth, which is similar to the other segments?
Well, as we said, that juice is not really subdued. It's done extremely well, but we have run out of capacity on Tropicana. So as soon as our second facility will be ready, we expect to see 100% growth on that. And the facilities are ready.
And when will that be, sir?
Hopefully, it should be next year sometime.
The last question that you were in discussion of margin, while gross margin has gone down, you have done some operational savings. So I missed that point. I thought that you were talking about some kind of a 21% kind of EBITDA margin.
So, but that is throughout on a yearly basis. So our first quarter is a subdued quarter, so our EBITDA margins are always lower. If you see our second quarter, you'll see our margins much higher. So on an average basis throughout the year, it averages out to about 21%, and that's the guidance we have been giving basically. And
despite the raw material prices going up so much.
That's right.
Thanks a lot, sir.
Thank you.
Thank you. The next question is from the line of Alisha Mawla from Envision Capital. Please go ahead.
Hi, sir. Good evening, and thank you for taking my question. While most of my questions have been answered, just wanted to understand with respect to the Kurkure Puff Corn, what is the kind of investment that we're looking to make?
About 23 crores.
It's a very small investment. We are testing it out. So it's about 23 crores.
Okay. And this is only for co-packing. We are not going to be doing any manufacturing.
No, manufacturing, of course. We will be manufacturing and giving it to PepsiCo.
Okay. And this is for pan-India? Do we have select geographies?
No, it's their choice wherever they want to take it. We just have to produce it and give it to them, and it's where they will sell it is their call.
Okay. Okay, great. The rest of my questions have been answered. Thank you.
Thank you.
Thank you. The next question is from the line of Suvarna Joshi from Quantum Advisor. Please go ahead.
Sir, thank you for the opportunity. Most of my questions have been answered, but I have two questions. One is you mentioned that the realization has improved because of price hikes and also the product mix. So if you can just help us understand the mix between price hike and price hike and the product mix, which is contributing to the 6% odd kind of a realization improvement on a YOY basis. That is question number one. The second question is, I wanted to understand the mix in terms of SKUs. Now, when we were in the COVID period and in-home consumption was very high, we had seen that larger pack sizes were doing much more sales. And now with out-of-home consumption being the driver, I'm certain that it is more to do with the smaller. So can you just indicate as in what kind of pack sizes are doing better for us and how do we stand over here despite the margin the gross margin pressures that we are seeing?
See, fundamentally, you are absolutely correct that as the go-to market has opened up, the small size, the 250 ml bottles, single size bottles have started doing extremely well, and the major growth is coming in that pack. And as far as your margins are concerned, you've asked, partly the increment in pricing has been very small, but what we've been able to do is reduce our discounting as the demand is high, and we've been able to convince the distributors and retailers that the costs have gone up, so we will not be able to give that kind of discounting.
Right. So, it is not the effective price hikes that we have taken which has led to this.
Partly, I would say, out of the 6%, maybe 1 or 2% is pricing, and the balance is efficiency and of course cutting discounts.
And how much of it would be from the product mix?
Product mix, I don't think has made that big a difference. It's basically minor difference. Of course, single serve is slightly more profitable because it's more on the go pack, so that has helped. So all the things mixed together has given us a 6%.
Sure.
Advantage.
That's it from my end. Thank you and wish you all the best.
Thank you.
Thank you. The next question is from the line of Devanshu Bansal from MK Global Financial Services. Please go ahead.
Sir, in continuation with the earlier question, I just wanted to understand, are in-home consumption trends sustaining, or you are sort of seeing a decline with on-the-go picking up? So this is basically to understand, has there been any
declining, but the major growth is coming on the go. So what the market was subdued, that has opened up. So people are going out, they're drinking out, the restaurants have opened, the hotels have opened, cinema halls have opened. People are traveling from one place to another. So railway stations, bus stations, all that has opened up. So that is where the major growths are coming. But I don't think the habit which has been formed by drinking at home has come down.
Sure. And secondly, also wanted to understand these, if I understand it correctly, the distributor commissions or discounts that you used to sort of account for have now been moved below gross margin level. And so is this understanding correct?
Distributor commissions have not been changed. It's just that, because of the costs, I think both the companies or all the beverage companies were giving more in the market as they were all felt the pain. So I guess they have curtailed part of the discounting, and partly it has got covered up by the extra volumes which we are doing.
Sure. Got it, sir. Thank you.
Thank you. Heyman, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you very much. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would you like to know more about the company, please feel free to contact our investor relations team. Thank you once again for your interest, time, support, and for taking the time particularly out to join on this call. Look forward to interacting with you soon. Thank you very much once again.
Thank you. On behalf of Varun Beverages Limited, that concludes this conference. Thank you for joining us, and you may now